Borough President Manhattan. Borough President Brooklyn.
Present.
Borough President Queens.
Present.
Borough President Staten Island.
Present.
Borough President Bronx.
Present.
International Brotherhood of Teamsters. Here. Transport Workers Union.
Here.
District Council 37.
Here.
That's all.
Right, unless we have anything before we start the public agenda, I think I'll just turn it over to the Controller's Office.
Okay. If everyone would turn to their March monthly performance report. We have extras up here if anyone needs one. Good? Okay. So these numbers are from the month of March. We're now almost at the end of May. So we'll go through those numbers a bit quickly, but I thought I just would want to bring everybody up to date on a bit what's going on with the markets, both the equity markets around the world and the bond markets, and what's been playing out. So we'll go through some of the economic charts, but the gist really is that the U.S. economy is actually seems to be doing okay. And the equity markets, even while they've continued to rise through this year, they're actually still reasonably priced. And yet when you look at the 10-year Treasury and where it is today, it's still showing some caution out there. So we've got this dynamic of things look okay, the markets continue to go up and are reasonably priced, but yet the 10-year Treasury is showing that there's still caution out there. So let's go through some of this and talk through it. And then, of course, you have the geopolitical events, what's going on in Russia and the Ukraine, which certainly adds to the volatility in the market. So let's turn to page 3. And this is a chart of the ISM Manufacturing Index. And so what you want to watch for this index is anything over 50 shows expansion in the U.S. economy. And so you can see right now we've been trending up ever since December of last year, and we're currently at close to 55, and this is as of the end of April. Right? So continued expansion in the U.S. economy. If you then turn to page 10, this is a chart of retail sales. And again, if you look at since the beginning of the year, the trend is up. And at the end of April, we're currently above 4. You look at the next slide, which is U.S. auto sales. And while, it ticked down a little bit from March to April, I mean, really, again, if you look at the trend up over the last several months, the trend is up. If you then turn to page 18, this is the VIX, the Volatility Index. Now, this is a market index, okay? So the economy seems to be doing okay. The VIX here now in April is at 13. It's at the lowest it's been on this trend line for a very long time. A spike indicates nervousness in the market, volatility is picking up, and this number is very low. So again, generally you're thinking that people are feeling pretty good about what's going on in the stock market. But then if you turn to page 20, this is a chart of the 10-year Treasury. It's actually dipped now. Martin, is it below 2.5%?
It's right on the cusp.
Right on the cusp of 2.5%. And just to give some perspective around this, a lot of folks in the industry, in the investment business, have been talking about rates should be actually over 3% by now. We're on our way to 4%. But here we are at 2.5%. So people are clearly still looking at what the Federal Reserve is going to do. They continue to taper, which they have been tapering their bond purchases. But all eyes are on Janet Yellen as to when she might consider raising rates, and that has been pushed out at least a year, maybe beyond that. I mean, she's become a lot more conservative in her look at what's going on in the economy. She took off the table this target of a 6.5% labor number that at that point she would consider raising rates, because now she's focused on the participation rate, which I think is the right number, the labor participation rate, which is still below what it was back in before the financial crisis. And so, you know, bond investors are focused on that, and that's where you see rates right there. To show you how the markets are being priced, going back to my earlier point about them being reasonable, you turn to page 23. So we look at this every month. So the top chart is the Russell 3000, right, our proxy for the U.S. stock market. The middle chart is the EFA index, which is our proxy for the developed markets, non-U.S. And then the lower chart is the emerging markets. And I know there are a lot of numbers on here. We'll try to clean them up a little bit. But what I will point you to is, okay, the far right, if you look at the top chart, the Russell 3000, the far right blue box, 13.19 times. See that? That's suggesting that if we took today's price and we looked out earnings 2 years and what's projected, the market looks actually kind of cheap, if you'd say that, relative to the white line. If you look at the box above, the 10-year average price to earnings multiple is close to 17.5 times. You look to the blue bar box to the left of that, which is 18.7 times. That's taking today's price on 2014 earnings, right? So the U.S. market is trading at 18.7 times this year's earnings. Again, if you look at the 10-year average, it's not that far off from that point. So we like to look out to the future to try to figure out how our market's priced. Are they rich? Are they cheap? So that the U.S. markets look okay. If you look at the next series of charts, the EFA markets, same thing. Current price on 2015 earnings is 11.9 times. The 10-year average, which is in white, is 20 times. If you look out on today's earnings, on 2014 earnings, it's 18.5 times. Again, 20 times is the average, 10-year, reasonably priced. The next series of charts, the emerging markets. Same thing here. Look out, next year's earning, it's 9 times. 10-year average is 13 times. If you look out on 2014 earnings, it's 12.2 times. So again, people are arguing, and these numbers would suggest it, that the emerging markets are actually cheap. And you'll see how the markets have responded, and the emerging markets have had quite a comeback in the last couple months. So now let's just go to March numbers and April numbers. So if you turn to page 27, so here we see the Russell 3000 up 53 basis points. This is the month of March. You scroll down to EFA, it's down 64 basis points. The emerging markets up over 3%. So a big month for emerging markets coming back on what people perceive as cheap valuations. You scroll down to the Core Plus 5, down 15 basis points. High yield up 23 basis points. Tips down 47 basis points. And convertibles down 1.74%. Turn to page 29. And these are the April numbers. Russell 3000, basically flat, up 12 basis points. EFA up 1.45%. Emerging markets up 33 basis points, so continue to be positive. Core Plus 5 up a little over 1%. High yield up 69 basis points. Tips up 1.35%. And convertibles roughly flat, down about 14 basis points. So if you turn to page 31, let's look at how NYCERS made their money in the month of March. In the far left bar, so the total fund was up about 75 basis points for the month of March. Big chunk of it coming from U.S. equities, big chunk coming from emerging market equities. If you then look a couple bars over, the fiscal year to date total fund return then, this is through March, is up 12.68%. Now, if you add in what we just went through in April, which we estimate we were up about 30 basis points, let's call it, that would mean then that NYCERS fiscal year to date through April is up 13%, which is a great number. If you turn to the next page, 32, this is how we're set up today as of March 31. So you might remember that last month we told the board that we had sold down our U.S. equities and added to Core Plus 5 to get back within the ranges, and that this month you would see that show up in the March numbers. And so that is in fact what you see here. If you look at the left green bar down below, we are now within the range in U.S. equities, and if you look at the the blue bar to the right, which is Core Plus 5, you can see that we're now within the range there. And you'll notice here that the total portfolio at the end of March for NYCERS was $51.6 billion. I can tell you that as of May 21st, which was last Wednesday, the fund is at $52.2 billion, which is the highest it's been and a really strong number. I'll just point you to a couple of more pages. If you turn to page 37. So far, so good in May. We got 1 month to go. If you see page 37, this is the last year's market values for NYCERS over this last year. So in 1 year's time, the NYCERS fund is up about $5 billion in 1 year. If you turn to the next page, 38, this is basically a 10-year snapshot of the NYCERS portfolio. And you can see the nice improvement and the nice performance here over this 10-year period. And down below you see the 10-year return as of March 31 for NYCERS is over 7%. So that's very good. The next several pages go through the performance by manager monthly for equities and fixed income, and then after that you have, and the other asset classes, and after that you have cash flows for private equity and real estate. And if there aren't any questions, then we can go to the next item.
I just find that we seem to be impervious to events that occur in the world. So it's rather astounding that the market seems to react to the Ukraine, Russia, all kinds of madness going on here.
Right, I know. You know, there's definitely choppiness week to week that we've experienced based on a lot of those issues you mentioned. So when we read that Russia put troops, closer into Ukraine, and the markets will be down 1% on that day, and then you see Putin say, okay, I'm pulling back, and then the markets are up the next day. Yeah, I mean, so I'm certainly cautious about a lot of what's going on in the world for that reason. But if you look at just the business fundamentals in the U.S., and if you look at what Europe is doing to get themselves out of some of the mess still from the financial crisis, so they still have a ways to go, but they're making progress, they're making effort there. And then you look at the emerging markets, which still are exceeding our growth by a lot, even while they have their issues with currencies and the like, and particularly what we're doing here in the U.S. with potentially raising rates on them, which would hurt their businesses and their economies. People are factoring in that so far things are not so bad. And given that, the markets continue to rise. Now, it's not a straight line, for sure. And there are times during these weeks where I talk to our team and our entire team, all right, are we missing something? Are we ahead of ourselves? Should we be trimming here? Should we be doing this? Should we be looking elsewhere? Should we be getting more worried about our managers in Europe? No, in fact, those are great opportunities. We should be looking more in Europe. When emerging markets were getting crushed, really, mostly over the last 3 years, and into the beginning of this year, I actually was looking at our ranges and our rebalancing ranges saying, if we just get a little bit lower, we should be buying more because, we're 30-year time horizon investors, and it's a great opportunity for us. So there's a lot of volatility intraday, intra-week, intra-month, but, so far so good. I mean, I certainly hope June is going to, even if it was flat, I'd be very happy for us to keep these numbers. Yeah, sure. Any other questions? Okay, thanks. So we'll now move to the next item, and I will turn it over to Susanna.
On page 67, the Controller's Office has a resolution that we'd like to offer for the board's consideration. The Controller's Office is pleased to offer this resolution that would formalize the current practice for all asset classes by prohibiting the use of placement agents or intermediaries, and align our practices with the state mandated ban for the state systems. Although some firms may choose to utilize placement agents or intermediaries, we believe that the potential for reputational and conflict of interest risks outweigh any benefits that could come to the systems. Engaging with small and emerging firms is a stated priority of the Controller. We are very proud of our recent efforts to reach out to a diverse universe of managers, and the Controller has made creating a plan a priority for his first months in office. The Emerging Manager MWBE plan was announced at a spring conference that was attended by over 700 such firms. At the conference, the Controller announced a new $1 billion commitment to emerging manager investments in alternative asset classes. He also explained a renewed commitment to engagement of small and emerging firms. That engagement includes a new designation of staff within the Bureau of Asset Management. We have one staff person in each asset class that is now dedicated to being a point person, to reaching out and meeting with emerging and small firms. We're revamping our website so all of the information will be readily accessible to individual managers, with the hope that they will not need to hire any kind of outside vendor to give them that information, and that the line to the Controller's Office will be open and direct. So we thank you for your consideration and hope you will join us in supporting this resolution, and I'd be happy to take any questions or discuss the resolution at this time.
Do we have any questions or discussion?
My question is, what are the small firms that for legitimate reasons engage the services of a placement agent, a third-party marketing firm? These firms may not, just don't have the bandwidth, they're busy
Right.
attending to their business.
Right.
There's a lot of people at conferences, and 700 people, wonderful turnout, but how then does a smaller firm sort of, they've engaged presumably a placement agent, third-party marketing firm to try to cut through the clutter and get a meeting, and, all very legitimate reasons.
Yeah.
So how does that then proceed in the absence or in the ban?
Right. Well, I mean, I think first it's important to realize that the systems aren't using placement agents currently. We have, I think, 2 investments that have sort of been grandfathered in from the past that were brought to us using placement agents. There's a ban in private equity, and I think most people understand that the Controller's Office doesn't really engage with placement agents currently because of the ban in private equity. And so, what we've thought about doing is trying to make things as easy and direct for these small firms as possible. So we're revamping our website, so in order to get a meeting, it'll be very clear who they need to talk to, what the phone number is. I think just, with all information in government, people don't believe that you could actually just pick up the phone and call the Bureau of Asset Management or someone else in the Controller's Office or some other elected official, but you really can't. I don't think that, I personally, my belief is in a democracy you shouldn't need lobbyists, you shouldn't need placement agents. People should have a direct connection to their elected officials. Well, lobbyists, there's lobbying in the good sense, and other kinds of lobbyists. I used to be Scott's director of budget and grants, and in order to get a capital commitment from our office, a lot of people thought they would have to hire lobbyists, and we said, don't waste your money. You can meet with me. I can explain the process to you. All the borough presidents know this. disengage with me directly. We redid the website, we made the application really user-friendly, and that's what we're trying to do here at BAM. So we have a real commitment to engaging with firms. We have designated staff people who are being trained. We're revamping the website, and we'll keep, tinkering with it. We want to hear, part of the conference was hearing feedback from small firms about what they need in order to, understand what the definition of an emerging manager is, understand how we define WEMB and, all of these different things that I think sometimes, busy firms would rely on an outside marketer because they didn't have time to understand that information. If that information is clearly articulated on our website, we have responsive people who are going to be meeting with different firms and sort of stepping them through the process. We really hope that that's going to address that very concern. And I think Martin had another.
Thank you.
You're welcome.
Excuse me, Ray, I do have one comment. To allay some of your concerns, I just want to remind you that this board has a history. We're going to be doing a developing manager search soon, but has a history going back to the early 90s of doing developing manager searches, meaning searches with direct relationships with small levels of assets under management. To my knowledge, in all those cases, starting from the early 90s when we first did the search to 99 to 2006, and now we'll do the fourth one, managers were able to, small managers were able to reach out to us in each case, in each of the cases. And this was under the old process where they had to actually fill out the old RFP, unlike the new process where the consultants will run the front end for us. So even under the new process where they run the front end for us, back in the day when we had the old process, they were able to do business with us in the developing manager search, at least in the public markets.
But it would be very hard to say that everybody was able to do it. You would never know that.
It's impossible, however, because of the new process, they don't need to, because it'll be by invitation. In other words, the consultant will be running the lists, will be taking the list together. If Callan thinks that a manager is worthy of further consideration, we will then communicate to that manager.
So we should get mad at the consultants and not.
Right, it's their fault.
No, the good thing is
So
that
that's the new improved process actually helps.
those databases include everybody. So we tell everyone, just get your information into those databases. As long as you do that, you will be looked at. Whereas, in the old process, it was you had to submit, and if you didn't know about it and you didn't submit, then you missed out. In this case, we just say, as long as your information is in there, and people always put their information in the databases. As long as it's up to date, you will be considered. You don't have to do anything, which is great.
There's a list for the city. And then you have to
No,
have,
there's not.
your name on the list, and then when they look into the
Just give me a name like that.
And just to clarify, there's no cost to a money manager to get in those databases. So I think that's an important. There's no financial barrier to get into those databases. I think that's an important point to stress.
I think any attempt to remove barriers, whether or not they're perceived or real, is a step in the right direction. And I think it sends a message that government is accessible, and that one does not need to hire a intermediary. So I think this is really a step in the right direction. I applaud the controller for this resolution, and at the appropriate time, would love to second it. You're welcome.
And any further discussion? If not, we have a motion to move the resolution.
Yes.
Thank you,
I
Pam.
second.
And a second? All right. All in favor, please say aye.
Aye.
Any opposed? Hearing none, that motion carries.
Resolution number 1.
The next item on the list is the basket clause update, and I'll turn it back to Susanna.
So we're moving with the basket clause, thanks to, I think, a lot of you who saw John's email from last week. We sent out information about the bill language, the status of the bill, our memo, and asked for the different trustees' support in writing letters or memos to the leadership both in the Senate and the Assembly. So as everybody knows, we have a Senate and an Assembly sponsor, both leadership positions, the chairman of the Finance Committee in the Senate DeFrancisco, and then Denny Farrell, who's chairman of Ways and Means. So we're just waiting for it to get on the committee schedules. I know there are good committees and bad committees, so we just have to make sure we get into the right committee. And any support and letters will certainly help, but I think it's moving, and we're cautiously optimistic. Any discussion or questions?
We are going to do a memo in support or whatever, and talk to the board president colleague, see if we can do something together. But actually, passing this, I'm thinking helps us with our emerging market issue. Not an issue, but it also gives us some flexibility to do some things that we might not be able to do now and capitalize on some things that I was hearing about earlier in the meeting. And I think that's really important.
That's right.
Mm-hmm.
Is it
DeFrancisco.
Sorry. Yes.
Okay, thank you. Thanks. So next up, we have a presentation from Callan on the emerging markets countries analysis. And I'll turn it to Bud.
Great. Good morning. As Andy Aseri makes his way up to the table, I just did want to go back for a second to allay any concerns, since Callan is doing the front end of the search process with regard to the placement agent discussion. We do have an open door policy. We meet with managers regularly, all types, especially the emerging managers. As John pointed out, our database is free, so we encourage everybody to fill out the questionnaire. And as I mentioned before, at one of these meetings, we do have the Callan Connects program, which is a proactive way of reaching out to those emerging managers in different areas of the country on a quarterly basis. So I hope you realize that we are also taking steps to meet and get to know a lot of those emerging managers, so we are familiar with them when we do searches for you. Now, to introduce the next topic, the emerging market country screen is something that Callan has been working with you all on since 2004. Prior to that, this board did not invest in emerging markets because they felt that it was, we didn't want to just give money to undeserving countries that were doing bad practices in the world. So we developed, with the help of the board members at the time, the screening process, which eliminates countries, so it's at the country level. Andy Aseri is here to walk you through this. He has been working on it with us since 2007. Andy is a vice president in our Global Manager Research Group in San Francisco. Prior to working with Callan, he was at NYCERS, which also had similar screens at one time. And I'm going to turn it over to Andy. We do this twice a year, basically. We come out and talk to you about this. At the May meeting, we sort of just review the process with you as to how we do the screens. And then at the September meeting, we deliver the results of which countries were excluded. And also at that September meeting, you decide whether you want to progress and renew the contract and have us do it again for the following year. So today is more of a refresher and review. I know there's a lot of new members. Please answer questions as we go along.
Thanks. It's good to see everyone. It's a lot of familiar faces and a lot of new faces. Just a bit of clarification, though. I was at CalSTRS, and we never did the country screen. CalPERS did that. But being the sister fund, we spent a good 2 years looking at that and considered it very carefully. So, but at CalSTRS, we actually did not do this screen. And so I guess, you know, as Bud said, we do this every May and September, and the cycle is in May we talk about the next screening, because we do the screening actually as soon as I get home. I'm going to start the screening, and then we deliver the results in September. So we use this as an opportunity to really discuss the project, discuss if there's any potential changes, and then also to just review some of the changes in the scoring universe that occur year to year. So if you look at the presentation that was handed out, we always like to just recap what we're doing here. And so on page 3, a little background. The goal of this project is to maintain exposure to emerging markets. I think we all agree that emerging markets offers a great investment opportunity. Any reason to exclude emerging markets it's going to be a tough decision. So that's our main goal, is to maintain our investment in emerging markets. And we do this because on the second bullet point, again, back in 2004, when the board was considering emerging markets, I believe there was actually a decision not to invest in emerging markets unless certain factors were considered. And these are non-financial factors, things that investment managers might look at, but certainly not the focus of their research. Again, as Bud said, we want to avoid investing in unfit or undeserving areas of the world. And so here we are in May to do our preview, again with the goal of delivering the search results in September. On the next page, this screening process uses publicly available information, and we always want to disclose and just make sure we're aware of some of the limitations that brings. One of the positives that's not listed is it's very cost effective. But we are faced with a lack of transparency in some of the scores. We use a lot of different data sources. We've looked at them for their appropriateness, but oftentimes we don't get the exact transparency, full transparency into how they do their scoring.
What is a passive use of publicly available information mean?
It just means that we go out and find publicly available information and just use it. We don't influence. We don't try to...
You just gather data.
Yeah, we just gather data passively. But as some of the limitations of passively using publicly available information is, we don't get full transparency in some of the scores. In other scores, we actually know exactly how these things are calculated, but in certain scores, there's a lack of transparency. The availability of the supporting information may not be consistent. In fact, we ran into that in 2007 when we lost a major data source. And so if you recall, in 2007, I ran a parallel scoring, one with an old data source and one with a new data source, because we knew the old data source was not going to be available. And we were able to find new data sources with similar ranking and information. Another limitation is a lot of this is backward looking. We've addressed some of this with the Verite source in terms of a forward-looking labor score. But most of the data is backward-looking. It does lack customization. Again, we are passively using this information, and again, changes in availability. And in fact, this year I am looking for a new trading cost data source because the S&P Global Market Fact Book is no longer being published, and we're not quite sure if they're going to make that information available online. But we are already starting to look for that data source. And trading cost information is fairly readily available, so we don't expect any issues with that.
Andy, can you explain the Verite?
Yes, so Verite is, so Verite is a consultant who specializes in labor practice evaluation. So they actually have a team of researchers who go to the countries and interview public officials, practitioners, industry folks, and come up with a series of scores on about 6 different categories within labor practices. They also evaluate the forward-looking nature of the scores and give us something that they expect. If there's an issue that they expect to arise, they actually can work that into what we call the forward-looking assessment. And so that goes a little bit to address the backward-looking nature of a lot of these scores. But in that next bullet point, in fact, because this project has evolved a little bit over the years, there used to be a volatility and liquidity factor that was removed because it was too volatile. We added the forward-looking labor factor from Verite, again, to address backward-looking factors. We added something because before we were using a labor practice service where we would just use the scores, but now I read stacks of country reports on labor practices. And so if there's ever an issue with a country, we actually know what's going on. So at the September meeting, if there's any questions about a particular country, well, actually, in the past, what we've done is if there's any questions about a particular country, I come back in October to talk about that, because it's a pretty big project, and it's tough to get the project done. We do look we do analyze the what's going on in the labor practices, but if there's any specific questions, the chances of me being prepared to adequately address it at the September meeting might be slim.
Just 1 minute, I got a question.
Mhm.
Sure. The UAE,
Yes.
big issue there.
Yes, in fact, when we're going to get to the new universe, because there's a couple of new additions. We have contracted Verite to look at UAE in this year. And we actually scored UAE last year. Yes.
Serious issues there on labor practices.
Definitely. Yeah, so we actually scored UAE last year, and then this year we're adding Qatar and Greece, but we'll get to the universe in just a second. And so, we always want to disclose some of the limitations and some of the things we've done to address those limitations. To the methodology, and this was again started in 2004, the board identified 6 broad factors or categories of factors that they wanted addressed. So we have those, and we'll go through those in the subsequent page, but there are 6 equally weighted categories of factors. In 2004, we would rank the countries, and there was an absolute level of 1.75. The scores go from 1 to 3, and if you had 1.75 or lower, you were eliminated, or you were prohibited. In 2008, that was adjusted to include the bottom 6 countries of the rankings, because what was happening is, on a relative basis, scores were creeping up, and we were getting to the point where actually, I think, in 1 year, there might have been 2 or 3 countries that were eliminated when there were concerns about maybe that 4th and 5th ranked country. So in 2008, we changed it to the bottom 6. One thing that's not on here is, as a country becomes prohibited, they actually enter a 1-year probation period. We wanted to reduce turnover, because some companies would dip into that bottom 6 ranking and then next year be up. We didn't want the managers to trade in and out that frequently, so in order to add stability, we introduced a 1-year probation period for a country that enters a prohibition status. From the beginning, there's actually been 2 additional what we call deal breakers. Again, at first it was 1.75, and then in 2008 it's the bottom 6. You can also be prohibited for 2 different reasons. If you had a regulatory or legal score of 1, we call that a deal breaker, and you should be prohibited, regardless of the rest of your rankings. If your regulatory and legal framework is not adequate, we thought that, or the board thought that was a reason for elimination. And then the other one is, the second deal breaker is a labor practice of 1 and a negative forward-looking assessment. So something that is ranking extremely poorly on the labor practices with a negative outlook. And so those are the 2 deal breakers in addition to the bottom 6. It just so happens in the last year, in fact, there were a couple of deal breakers, but they happen to be in countries that were in the bottom 6 rankings. So, but on page 6, these are the 6 categories of factors. I won't read them to you, but if there's any questions, this has actually been very stable since the beginning of the program. Some of the sources have changed, but we took care in making sure that new sources were consistent with the original sources. So if there's not any questions about the actual factors or categories, we'll move on to a recap of last year's results. So on page 7, last year in September, I came here and presented this page with some other information, but this is really the summary. On the left, you see the rankings of the countries on how they scored. The ones highlighted at the bottom are prohibited, with the exception of Egypt, because Egypt had entered the prohibition status last year, and so they entered a 1-year probation period. And so if, after this year's scoring, they remain a prohibited country, they will be eliminated from the benchmark. And I guess we should also mention the results of this is a custom benchmark. So you use a FTSE emerging market benchmark, And if a country is deemed prohibited, it is actually removed from the benchmark. I believe managers are allowed 10%, up to 10% out of benchmark exposure, so they can actually still invest in these, but very limited. And this would include everything from prohibited, that 10% would include prohibited countries, maybe developed countries, any country that is outside of the FTSE Emerging Market Index.
And also we have in our guidelines that the board-approved language, that if the manager wishes to invest in those countries, they have to confirm with us that worker rights, the rule of law, and things like that does not affect the investment that they're intending to make.
What did you say?
We have the board-approved language, and we have in our guidelines written up for the countries, if they wish to make investments in these countries that are not on the list, they have to send us a certification that says that the companies that they're investing in, the worker rights are protected, the rule of law is in effect, and other protections are in place that make the investment prudent.
Does that statement also include any human slavery?
It's not explicitly in there, but it would be in the labor rights, presumably. But that was a board language a language that the board approved several years ago.
And as you might imagine, very few managers take us up on
In
that.
fixed income, in all the years since this has been going on, 5 years plus, I'm not aware of a single manager that has taken that on.
And so on page 7, just to recap, I guess the bullet points in red really summarize what happened last year. There were 5 countries that were prohibited because they had been prohibited for at least a year and had gone through the probation period. And so Argentina, China, Indonesia, Pakistan, and Russia were all prohibited from the index. Egypt, again, 2013 was the first year that they were in the bottom 6, and so they are finishing a 1-year probation, and we'll see how that turns out when we do the scoring. And Morocco had graduated up. There were some improvements in the regulatory and legal score, and that was enough to get them out of that bottom 6. Just above the red highlights that were the deal breakers, Russia and Pakistan had failed the labor practices provision. Both of them happened to be in the bottom 6. And then Argentina failed the regulatory and legal deal breaker, and they happen to be in the bottom 6 as well.
Yeah. You'll take an extra look at Thailand now because there was a military coup, or was that?
Yes, well, we will look at all the information that we always look at. Verite is going to do the same labor review they always do and do the same forward-looking assessment that they always do. Yes, and you know, the backward-looking nature of some of this is, it may not actually show in some of the factors, but with the Verite process, there's certainly a forward-looking assessment. All right, so how has this all turned out on page 8? And again, you know, we're not doing this as a return enhancement. We're doing it to address concerns of the board in investing in these countries and whether the practices of these countries warrant investment. It just so happens that things have worked out very well. I think the big thing is on the top set of numbers, the top table, there's 2 red lines. And that is a difference between your custom benchmark and the standard benchmarks. So the NYCERS custom FTSE benchmark minus the standard FTSE benchmark, over 7 years you'll see it's outperformed by 72 basis points. In the last 3 months ending March, and I would say that this number has actually grown, the benchmark, the custom benchmark has outperformed the standard FTSE by 1.9%. And over that same 3 months, it's outperformed the MSCI benchmark. We just put that in for reference by over 2%. And the vast majority of this is the exclusion of Russia. Over previous years, there's been a benefit of excluding China because China has been a lagging country. But again, the purpose of this is not to pick those underperforming countries because things could very well reverse. China has underperformed because of a slowing growth rate. And we all know why Russia has underperformed. So,
Andy just mentioned the difference between the NYCERS custom index and the other 2 widely recognized indices, but your active managers have actually even done a better job. So on a relative basis, they've done very well.
yes. All right, so on page 9, a preview of what we're going to be scoring starting next week. And so the additions are really Greece and Qatar. Greece has entered the emerging market universe, previously a developed market country. They've been developed for 12 years, and so they are now emerging again, so they will be included. Qatar is being promoted from frontier to emerging by MSCI, so a lot of emerging market managers are now considering Qatar in their investable universe. You mentioned UAE. We actually added UAE last year to the scoring universe, so that will continue to be part of the group that we look at. And so, just in conclusion, the universe has expanded by one by adding Qatar and Greece and removing Argentina. We are removing Argentina because it is no longer an emerging market country by any of the major index families. We probably scored it a little longer than most because most managers consider investing in Argentina. But now that it is firmly outside of the benchmarks, it is now just subject to the 10% limitation. And, just want to review the methodology. We are still, yes?
Question, if Argentina isn't emerging, then is it developed?
It's right here.
Oh,
Below.
Yeah, it's below. Yes. It's not quite as bad as Venezuela, because Venezuela has actually dropped from coverage. It's not even frontier. Argentina, at least, it's still frontier.
How does one determine frontier?
Frontier is a term which basically is a catch-all. If it's not developed, which is the highest level, and if it's not emerging, if it's neither of those, it's frontier, if there's a market. There are a lot of countries without a public stock market, and so they won't even be frontier. But frontier is just a default that it's not developed and not emerging. And there's nothing above developed, so these are all the least developed economies. But there is a frontier index.
Give a sense of what that represents as a percentage of world markets, less than 1.
Yeah, it's like 1.6%, I think, of the global market cap.
It's a very small portion of the overall stock market.
And Argentina is probably the biggest country in the frontier. Or actually, no, it's actually Kuwait. So, Kuwait is the largest. Well, it was, yeah, so it was really the Gulf cooperation countries, Qatar, UAE, and Kuwait. And UAE and Qatar, again, were graduating to emerging, so Kuwait remains the largest country in the frontier.
Well, they call it Qatar or Qatar, whatever, but
Yeah.
nobody works there. Is that the place where the folks don't have to work because there's so much income?
You were
from oil?
born a millionaire
Yes.
with oil revenue or royalties paid to individuals, yes. But inflation's crazy, so everything's very expensive.
But Andy, in an economy which is, my understanding is just oil, then what separates emerging from frontier,
From developed.
Well, the frontier markets are actually very
what's the point of
interesting.
differentiation?
Some will say it's arbitrary. It's determined by MSCI and FTSE and Russell, and every major index provider defines country classification. They just all happen to be very similar. There are a couple of countries that are different in the emerging and frontier indices between FTSE and MSCI, but by and large they're very similar. They all have similar kind of liquidity caps, market capitalization, listing requirements. They all look at very similar things in determining the country classifications for their different indices. But yeah, where you draw that line is, and I think that's why you have a 10% ability to go outside the benchmark, because some would say it's arbitrary. But all your asset allocation, all your asset liability, all your studies that have gone into determining your structure include the emerging market index and the developed market index. So anything outside of that is out of benchmark, it is outside of the assumptions that you are using to determine your asset liability. So as arbitrary it is, we all use it. Yes.
Yeah. The Dominican Republic and the various countries of the West Indies, they're regarded as frontier?
Yes, in fact, the easiest way is to go to page 9. If it's not here, it's frontier, unless it's a developed country. And the countries you mentioned are not developed, so those would be considered frontier.
I ask because, I mean, it's a different fund with different standards, but the Dominican Republic, Trinidad, and a couple other countries of the West Indies are on the permissible countries list of the TRS. As I recall.
Do we invest in frontier countries? Have we invested?
We have in the past with active management, which, for a variety of reasons, those managers were terminated, in large part because of performance. In other cases, it was not sticking to the strategy they initially were hired for by the board. So the exposure that we have now to frontier markets is small, and it's in predominantly our quantitatively driven emerging market manager, which NYCERS hired, which is Eaton Vance.
And it's very common within the emerging market universe of active management for opportunistic frontier exposure to be there. It's kind of like IFA Plus was 20 years ago. We actually call it Emerging Market Plus, where you're predominantly emerging markets and opportunistically you have some exposure to frontier.
We have a question over here.
On behalf of the public advocate, in terms of frontier market exposure, when it comes to the emerging market investments, there's a requirement that if they go outside of the list, that there is a disclosure that the individual asset that's being invested in meets certain minimum requirements. As you indicated, there hasn't been any of those in the recollection. But if a manager goes outside of their list and they go to a frontier market, are you asking them to make the same representations, or are they kind of not on this list, so they're not focused on that aspect?
Yeah, no, Tatiana, you want to answer that specifically?
In all honesty, Vance has done a good job at actually performing without doing too much frontier markets in NYCERS, just the ones in the other systems. But when they want to come into a market, they do give us documentation of why they want to and why they think it should be added.
Yeah, so the same rules apply there.
And so that is actually the conclusion of my piece. And I thank you. I look forward to this project every year. It's funny because when I was at CalSTRS and we were looking at the CalPERS program, I was very happy that when I joined Cal in 2006, it was kind of like the first project that was given to me. And so I'm very familiar with this process. I'm very familiar with the goals that we're trying to achieve here. And it's fascinating reading all these reports. So thank you.
Thank you. Okay. Thank you very much. So if there aren't any further questions, that concludes the public agenda for the Comptroller's Office.
Next, we have a motion to go into executive session.
So moved.
Any second? All in favor? Say aye. Aye. Any opposed? Hearing none, motion carries. And we'll go into executive session.